This video discusses logic for corporate diversification, a possibility of corporate over-diversification, and if so, ways to repair an over-diversified firm. Let's first take a look at ways in which a firm might diversify. And an example of recent firm diversification is that of Microsoft's agreement to buy the smartphone hardware business of Nokia. Nokia is a Finnish firm. This is an example of product diversification. And product diversification can be adding new products or new business segments that offer new products that are either related or unrelated to the core products of the acquiring business or diversifying business. Another form of diversification is that of geographical diversification. A form of that is by going global. Microsoft is currently a global business, but by buying a Finnish firm, this certainly signals that Microsoft is continuing its global reach. Why diversify in the first place? Let's take a look at a couple of different firms and how they've diversified and maybe why they've diversified. First, consider Gatorade. Gatorade is a subsidiary of Pepsi. Gatorade has diversified away somewhat from its core sports rehydration drink by going into its G series fuels, which are sports fuels for pre-workout. They call them Prime. The post-workout is the thirst quencher, and also protein-based recovery drinks. Why diversify away from the original flagship Gatorade brand to begin with? What this does is it reduces the risks of having all of your business focus on the success of only one product. So as you diversify away from one product, you're diversifying away your risk by entering new different business segments with different expectations for growth. The second reason in general why a firm would diversify is simply to grow or get larger, because by virtue of adding a new product or a new business segment to the corporate portfolio, you typically achieve corporate growth in terms of assets and also in terms of sales. In some cases, a firm may choose to diversify to get out of an industry that it's currently in that may not be so attractive and trying to find another industry which has higher potential for growth. An example of this in late 2013 is Kodak. As they emerge from Chapter 11 bankruptcy, they have come out as a brand new firm instead of relying now primarily on 35mm film and similar products. Kodak is positioning itself as more of a business solutions type of company with a heavy emphasis on printers. The theory behind diversification is based on portfolio theory, the theory in which you would use when investing in the stock market, for example. So if you consider the average expected returns and you want to maximize though in your own personal stock portfolio, and then you want to consider the number of uncorrelated stocks that you will add to that portfolio, the theoretical relationship between uncorrelated stocks and average returns is that by adding more and more stocks or uncorrelated stocks, you'll eventually hit some optimal level of return, and this optimal level of return is based on the fact that you've mitigated away some risk by just staying in one, two, or three stocks. Depending on who you talk to, there's some optimal number which would be around where my cursor is, between 12 and 20 uncorrelated stocks, and again that depends on whose theory you ascribe to, but the point is the more uncorrelated stocks up to some point you add, the better average return you'll expect based on mitigated risk. It's a different relationship when you consider diversification and corporate profitability. While you still have on this x-axis a level of diversification, what you now have in the y-axis is profitability of a firm. And the strategy research implies that there's an inverted U relationship here between diversification and profitability. And the very puzzling thing about this to many is that why is it that at some level of diversification that goes out to where my cursor is, does firm profitability tend to decline? This does not always happen, but there's a great deal of empirical evidence to suggest that it often happens. So the question for us is, why are there diminishing returns, or actually negative returns, over some high level of diversification? In other words, a level of diversification that's dysfunctional. In answering this question, let's take a look at Sara Lee, a firm that operated very successfully for the last 50 years, but also broke apart and was sold into two separate divisions in 2012. Let's consider the 90s and also this millennium for Sara Lee. Sara Lee underwent a time period where there were diminishing returns, especially in the stock market. Investors started to devalue the worth of Sara Lee. Sara Lee had begun to diversify into a number of other products over the years besides just foodstuffs. The first reason that you typically would see in explaining diminishing returns or why does too much diversification hurt is a dilution of a topic called dominant logic, and I'll discuss that on the next slide. It's easier to consider for the present time control costs. As a firm diversifies into multiple businesses, which Sara Lee did in the 90s, the information technology needed to track all of those business units becomes very burdensome. Let me explain. Sara Lee started out as just a bakery type of company, and over the years they added more and more business segments to that portfolio. And a lot of these segments were in areas that were totally unrelated to the core business that Sara Lee first started out with. So the more business segments that Sara Lee had in the 1990s, the more money, the more time, the more managerial focus, and the more opportunity costs were spent on trying to track all these multiple business units. The dominant logic explanation is like this. Dominant logic is a strategy concept where management is able to see and use commonalities among related products and business units. Sara Lee in 2012 consisted of the bakery, the mainstay Sara Lee firm, a number of other types of bakery products, and also different types of convenience meats. So, in other words, Sara Lee had grown to become just a food company. And the commonalities would be pretty easy to find as Sara Lee reaches out to grocery stores, for example, to do business. The commonalities among all these related types of products, which Sara Lee was as of 2012, they'd share marketing schemes. Sara Lee, ballpark francs, for etc., distribution channels. A lot of these products are going through the same distribution channels as they hit grocery stores. Some of these products share the same manufacturing facilities, and in general you just want to work with a portfolio of products that just seem to work together for all the aforementioned reasons. If so, they're commonalities, and if you're able to make it work, then you have some dominant logic in helping your firm manage a related portfolio. The problem is for Sara Lee, or the problem was for Sara Lee in the earlier part of this millennium, is that when you diversify too far away from your core business, you'll dilute this dominant logic. And what happens is that then to management, or in managing the firm, the big picture or the core business becomes blurry. You kind of lose sight of that which you're best at. Let's take a look at Sara Lee to finish this consideration of diversification. Sara Lee began as a bakery company, added coffees and teas over time, got into skincare, healthcare, European business, diversified further into underwear, and you can see the profitability curve. This red line is starting to plateau out. Over time, Sara Lee diversified further into leather goods, Mark Cross, the Coach also, and eventually Sara Lee wound up in tobacco. And in the late 1990s, the investors viewed Sara Lee as having a depressed stock price, quite possibly due to over-diversification. So how do you fix this? It should be pretty intuitive just by looking at this screen what Sara Lee should have done and what they did do. How do you repair an over-diversified firm? By a technique called refocusing, and that is you just want to get rid of some business segments. Now, which business segments would be prime for divesting from your corporate portfolio? In general, you want to eliminate business segments that first and foremost are just simply losing money. And in the case of Sara Lee, none of those segments are losing money, but this just makes good business sense when you look at a portfolio. First, look at the loss leaders. You also want to eliminate business segments that dilute your dominant logic or take your focus away from that which you know best, or eliminate business segments that just don't fit with your overall business strategy. A general mantra in strategy is to stick to what you know best. And what Sara Lee seemingly knew best was that of the bakery, meats, convenience foods, in grocery stores type of business. So we now look at Refocusing Sara Lee, which began in the late 1990s. And you'll look over here on this axis, the y-axis, you'll see profitability. That's actually stock price performance relative to the rest of the market. What Sara Lee began to do was divest itself, and tobacco was the first to go, and its performance decrease went away with part of that divestiture. In 2000, the year 2000, Sara Lee divested the Mark Cross and Coach brands, further retracting away from high level of diversification, and there were some performance improvements in the stock market. Sara Lee in 2006 sold off their Hanes business, again retracting back and improving profitability. And then finally, in 2010, Sara Lee sold its Sanex body care business, which was also unrelated to its core business. In doing so, they remain as just one company that is only in foods and only in the United States and Europe. This is the view of Sara Lee in their post-restructuring period. And now in 2012, shortly after Sara Lee refocused back to a reasonable set of core businesses, they split and became Hillshire Brands and the DE Master Blenders. Nevertheless, this is a good example of how a firm could over-diversify and then fix that diversification with respect to pruning level of diversification and improving a level of profitability or stock market performance.